Everyone, welcome back to my channel. I'm Justin Roman with Iron Valley Real Estate Prestige, and today we're kicking off an exciting 3-part series all about buying a home with a VA loan. Whether you're a first-time home buyer or just looking to brush up on your VA benefits, this series is packed with everything you need to know, and I'm here with Wendy Edde, who's going to be helping us today break it all down. Let's get started.
So I'm just going to do some quick introductions. I think most of you know me, but I have worked at Veterans United for 9 years now. I am partnered with my best friend and loan officer, Allie Schellenberg. If you haven't worked with me, you may have worked with Allie. Allie and I have been between the two of us have over 30 years of financial experience, and we've closed over 4,000 VA loans. So what are the main benefits of the VA loan? So really the main benefit is that there's no down payment. It's really the only loan out there that has a true no down payment benefit. The reason being is that the VA guarantees the loan 25%. So it's as if the veteran is putting 25% down because the VA is guaranteeing it. So if they default on that loan, the VA is going to back it for up to 25% of what that house is worth. So it's a really low risk investment for investors. Because the VA is guaranteeing it 25%, there's no private mortgage insurance. So unless you put 20% down on a loan, there's going to be private mortgage insurance. Your FHA, your conventional is going to require 20% down to avoid that private mortgage insurance. So this can save $200, $300 per month by saving on that private mortgage insurance. And again, the reason why there isn't PMI is because the VA is guaranteeing it 25%, which is more than the traditional 20%. It also has a lower interest rate than other types of financing. Again, the reason being it's a low risk investment for lenders because the VA is backing it 25%. Veterans also tend to be a little bit more financially responsible, so they have a low default on VA loans. That being said, the interest rates are going to be lower because it's a less risky investment for lenders. The seller can pay all closing costs, and we're going to really dig deep into this on what the seller can and can't pay for because there's some great benefits that the VA allows in seller paid closing costs and concessions. And then it can be used multiple times. So a lot of people think, oh, I've already used my VA loan, I can't use it again. Or I bought a whole house and I sold it, I've already used it, I can't use it. This is not true. They can use their VA loan multiple times. Then it also has softer qualifications than other types of financing. So the VA only requires a 620 credit score, and then it has less risky or less restrictive seasoning on like any kind of major derogatory items, which we're going to go over. So here's some myths about a VA loan. So some people think I have to have a perfect credit score to get a VA loan. That is not true. Most lenders only require a 620 credit score. So just to put that into comparison, a perfect score is an 850. Your average conventional loan is 758, and the VA minimum is a 620. And then I just want to go over a breakdown. So you can see like VA and FHA are 620. Seasoning after bankruptcy is 2 years. Seasoning after foreclosure, 2 years, 3 years on FHA. Seasoning after short sale, 2 years, 3 years. And then on conventional, you can see that it's 4 years for bankruptcy, 7 years on foreclosure, and 7 years after short sale. So it's softer qualifications on VA. So some people think, oh, it's better to go with a conventional loan. Actually, it's a lot easier for underwriters, for lenders to get a VA loan through than even conventional financing. So especially on the listing side, when you have a conventional deal versus a VA, I really like to point this out because if you're like, oh, we should pick the conventional loan because that is a better loan, that is misinformation. So really the VA loan is the least restrictive on derogatory, higher debt to income ratio. It's a lot easier to get a VA loan approved than it is a conventional loan. So I like to point out things for you guys that on the listing side too, when you're getting presented with VA offers. Other myths about the VA loan, I can only use my VA loan when I'm active duty. That's not true. Once you've served 90 days of active duty status, you're eligible. As long as you have an honorable discharge when you separate, then you are also eligible. My previous VA loan was foreclosed on, so I can't use it again. That's also untrue. So if you have a home, say it was $200,000, foreclosed or short sold, right? You still have remaining benefit left. So next year, the VA loan limit, the conforming loan limit is going up to $805,000. So you would still have like $605,000 worth of benefit left even after foreclosure or a short sale. I can't buy a home until 7 years after my bankruptcy. So a lot of people have that 7 years in their head because they've heard it. It's only 2 for VA. My VA loan entitlement has expired. Once you get that VA benefit, as long as you're honorably discharged, then that VA benefit does not expire. You can use it anytime. So who is eligible for a VA loan? So this is important as you're talking to prospective buyers and they say, oh, I'm VA eligible. You need to really, oh, great. Were you active duty? Were you reservist? Oh no, my dad was VA and I'm going to use his VA. So really ask those questions. Do you have your certificate of eligibility? And we're going to go into that. But basically anyone who has served active duty, Army, Navy, Air Force, Marine Corps, Coast Guard, National Guard, 90 days of active duty status. So that's typically once somebody graduates from school or boot camp, then the active duty status would start that countdown. For reservists, the reservist is 6 years of reserve continuous service, but a lot of reservists are called to active duty. So even if you have a reservist, they're like, oh, I've only served 4 years. Well, were you ever activated? If they were activated and they've served the 90 days under active duty status, then they are also then eligible. I would say most reservists that I come across, they have been called to active duty status at some point. Again, they need to maintain that active duty status. How do we determine if they're eligible? So because we are a VA-focused lender, when we input the application, we're automatically going to pull that certificate of eligibility when we put in the application. 9 out of 10 times it's going to pull for us. If for some reason it doesn't pull, we'll get a point statement if they're reservists, and we're going to get a DD 214 member 4 copy if they were active duty. You always want to look for on your pre-approvals, especially on the listing side. Again, I like to point out things to help you on the listing side. When you look at the pre-approval, you need to see if it's contingent upon a certificate of eligibility. If it shows that it's still contingent upon a certificate of eligibility, you want to call that lender and say, hey, I see that this is still contingent upon their certificate of eligibility. Do you have that, or what's going on with that? A lot of times that's contingent because they're waiting to verify if they're really VA eligible. So that is something to look out for on your pre-approvals on the listing side to make sure that it's not contingent upon that certificate of eligibility. So like on our pre-approvals that will automatically, we have to if we get the certificate of eligibilities, we have to check it off that we have it. So again, something to help you guys out, look to make sure that they have that certificate of eligibility. Now, who can finance? So these are great questions and some of our common questions. So it can be a veteran, again, a service member who's served 90 days active duty status, or reservist who's served 6 years continuous or was called to active duty status for 90 days, okay? It can be a veteran and a spouse. So it's not a veteran and fiance, a girlfriend, brother, a sister, a son or daughter. It's a veteran and a legally married spouse. Or it can be a veteran and veteran. So if the son is VA eligible, if the fiance is VA eligible, if the mom or the dad is VA eligible, they can then be on the loan because then they are both veterans. And we would do what's called a split entitlement. So a veteran and a veteran can be on the loan together, both occupying the home. The last option, which isn't talked about a lot, is that you can add another person with a 14.5% down payment. So for example, I had a mom and a son buy the house, and the mom wanted the son to be on the loan because she was going to deploy. She was a reservist getting called to active duty status. She wanted the son was going to live in the house. She wanted him on it so he could handle everything while she was gone. So she chose to put 14.5% down to add him to the loan, even though he was not VA eligible. So something to note that most people don't know, that there is this one offer with the 14.5% down payment, you can add somebody that's not a veteran or a spouse. So occupancy. So these are really good questions. So the veteran has to have the intention of living in the house for 1 year. Again, they have to have every intention of moving in and living in that house for 1 year. They intend to make it their primary residence for 1 year. What can they do after 1 year? Anything they want. They can rent it, they can sell it, they can use it as a second home. Once they've fulfilled the occupancy of 1 year, they can do whatever they want with that house. Now, there's no VA police that monitors this. When this comes up is, say you have somebody that's buying a house, John's buying a house, and then you come and say, hey, Wendy, I want to turn that house 3 months later into a rental and I want to buy again. Well, there has to be a good reason. It's not that it can't be done. It just has to have a really good letter of explanation. So why are they going to move out after 3 months? I've had situations where they're going to have a baby they weren't expecting. They got orders unexpectedly and they need to move, new job, medical changes, maybe mom or dad is moving in with them. So if there's a good reason why they're not fulfilling the 1 year, we get a good letter of explanation. And where does that go? It doesn't go to the VA, it goes to the loan underwriter. So again, if they're moving out after 3 months, they're gonna rent, this doesn't come up. The only time that this comes up is if they are moving out and trying to buy or use their VA loan again. And it doesn't go to the VA, it goes to the loan underwriter who has, who basically is working on behalf of the VA to make sure we're following the rules. And we have a really good letter of explanation to make sure that that makes sense. So again, you have to have the intent of living there for 1 year, but if extenuating circumstances arise, they can turn around. I did have one person who moved in, there was a shooting in the area, so they didn't feel safe. So they converted to a rental and literally bought 2 months after that. And a really good letter of explanation why they did that, and the underwriter accepted that. So let's talk about the actual property. So what can be financed? So it has to be in good condition. It can't be a tear down. It can't be a fixer-upper. It can't be half ripped out and you're gonna go in and finish it. It really needs to be safe, sound, and sanitary is what the VA appraiser is gonna look for. Now, if you want it to be given value, say they added or converted an office to a bedroom, then it needs to have documentation that they got permits to convert to a bedroom. It's not that it can't be done. The appraiser's just not gonna give it value if it wasn't permitted. So they'll still count the square footage. You can still do it. But if you really need that fourth bedroom to meet value, that's where it could become an issue. So a common question is, hey, this has an unpermitted garage conversion or maybe a converted ADU. You can still do it. You just may not get the value. So you really wanna have comps to support the purchase price. So the veteran can buy a single family home and up to a 1 to 4 unit property. They can buy a townhouse, they can buy a manufactured home, and they can buy a VA approved condominium. So condos must be VA approved. The reason being is that the veteran, when they buy a condominium, they own the walls in as their own. All of the exterior is a shared space, and that's why it's subject to condo rules and regulations. So the VA wants to make sure, A, are there leasing restrictions? B, is there enough funds in reserves if anything were to happen with the association? They want to make sure that condo is in good standing to protect the veteran. And that's why the condominium itself has to be VA approved. And when in doubt, you guys can reach out to me and we can look it up to see if it is approved, if it's ever been approved, if it was denied, why it was denied, maybe it's expired. So just reach out to me and we can take a look for you. So how does that VA appraisal process work? So they use a comparison approach. So the VA appraiser is going to come in, they're going to look at properties. They're going to look to see what has sold in the last 6 months. So they're going to say, oh, here's a 3-bedroom, 2-bath that it's sold 3 miles away for this purchase price within the last 6 months. And that's how they're going to determine value. So they're going to use a comparison approach. They're also going to make sure it meets minimum property requirements. Does it have smoke detectors? Is the water heater strapped? Is it, secure foundation? They're going to make sure that all those minimum property requirements are met. And then again, it needs to be safe, sound, and sanitary. Those are the 3 things. And so as you can imagine, every appraiser is a little bit different. And so not all appraisers are going to treat a property equal. So it's really your job as the listing buyer's agent to determine, look at it from an appraiser's eyes and say, is this safe, sound, and sanitary? And also to have comps available to make sure that the buyer's paying the right price, because those may come in handy if there's a tidewater, which we'll get into. So the truth about the VA appraisal, the bottom line is the VA appraisal is pretty much the same as conventional FHA, USDA. It's all going to require safe, sound, and sanitary because at the end of the day, the house is collateral for the lender, okay? The main difference between VA and FHA conventional is that it does require clear termite and moisture in this area. So we'll go into that, but otherwise everything else is going to be the same from conventional to FHA. Has to have adequate plumbing, heating, roofing, loose paint scraped or repainted, paint needs to be repaired, no leaks, excessive dampness or decay, no termites, destructive insects, fungus, or dry rot. Or those repairs need to happen prior to closing. So why are people hesitant? So if you have a buyer that says, oh, I don't want to do the VA loan, I heard there's this big fee, And I think you pay it every year. Like I hear that sometimes. So there is the most expensive line item of a VA loan is the VA funding fee. So there's a one-time upfront funding fee of 2.15%, which is rolled into the loan. It's one time. It's not like a yearly due subscription or anything like that. It's a one-time 2.15% VA funding fee rolled into the loan. The VA funding fee is the only part of closing costs that can be rolled into the loan. No other third-party closing costs can actually be rolled into the loan. They have to be negotiated with the contract. Now, if they are using that VA loan a second time, then the VA funding fee goes to 3.3%. That can be reduced with a down payment of 5%. So if they put 5% down, it reduces it to 1.5%. If they put 10% down, it reduces it to 1.25%. And then for those service members with a disability claim, so they get some form of disability, or Purple Heart recipients are exempt from the funding fee for life. So a lot of people getting out of the military, a lot of those service members do have some type of disability rating where they're exempt from the funding fee regardless. And that is included on refinances. So you can see, especially on that second time use, whenever anyone's doing a second time, I highly encourage they come up with the funds to put at least the 5% down because it cuts it almost in half. And you guys can feel free to take pictures of the slides. Like if you want to take notes, you can take pictures. So right now the conforming loan limit is $766,500, but this is going up to $805,000 next year. So make a note of that, save that, because what that does is it increases the buying power for our veterans, especially on a second time use. So I just want to kind of go over what that means. So if somebody's never used their VA loan or they had a VA loan and they paid it off, okay, now their entitlement is free and clear. They can buy up to a $2 million property without any money down. There's no limit on what they can do based on their qualifications. So they still have to have, look at the debt to income, look at their credit scores, but they can go up to $2 million with no money down with a free entitlement. Now where this goes into play is if they've used their VA loan and they save that property, now it's a rental or second home, and that property was $300,000, then that is where that's going to come into play. So that's why it's valuable. So if that's going up to $805,000 next year, that's going to give them that much more buying power without that down payment. So for example, on a $300,000 purchase today, they could go up to $426,000 on a second time use purchase without any money down. But let's say they want to go $100,000 over that. Well, because the VA only guarantees 25%, they only have to come up with 25% of the difference. So in this scenario, say they go up to $526 purchase price, $100,000 over, they just have to come up with $25,000. So it's the difference between the purchase price, what they're eligible for. They just come up with 25% of the difference. A lot of people think they have to come up with the entire balance, the entire difference, and that's not true because the VA, again, only guarantees 25%. They only have to come up with 25% of that difference. So that's something to know. And we have an entitlement calculator. So when we do their application and pull their certificate of eligibility, we'll put it in a calculator and determine how much of a down payment they need to put down. So this is another common thing that I hear from my veterans. Like we'll get a contract and there's no seller paid closing costs. And they're like, oh, and we're like, hey, where are you gonna come up with the $9,000 for closing costs? They're like, oh, I just gonna roll that into my loan. We're like, no, you can't do that. They said, well, on my last purchase, I didn't have to put any money down. We just rolled it in. Well, this isn't true. What they did was they asked the seller to pay the closing costs. And the agent may have said, oh, we can go up to $309 and we'll roll the $9,000 into the loan. So that the only way to roll in the closing costs is to negotiate it in the contract. And so it gets really confusing for buyers. That's why it's really important when you guys do those buyers consult that you're very forthcoming with what the costs are. Because even though there's no down payment, there's still third-party closing costs to buy a house, right? So we're gonna go through that a little bit more. So again, the only part of closing costs, and this is where it can get confusing, is that VA funding fee is the only part of the loan, part of closing costs that is actually rolled into the loan. All other third-party closing costs need to be either negotiated or paid by the buyer. So here's some options for closing costs. So the seller can contribute up to 4% concessions plus 2% in closing costs, so a total of up to 6%. And I'm gonna go over that in detail. They can use a 401k or a TSP loan, which is a thrift savings plan similar to a 401k. They can borrow at typically a 0% rate, or even if they pay it, they're paying themselves back. They can use a home equity line of credit on their current house. So if they're keeping a house and they're going to convert it to a rental, they can get a home equity line of credit, which is essentially a second mortgage, and use that as a down payment or as towards closing costs. It can be gift funds from a family member or family type member, like a godmother, godfather, aunt, uncle. And then it could also be a personal loan. The personal loan, the debt for the personal loan will count against their debt to income ratio. And we're gonna go over that. So what can kill a deal? So say somebody's bringing this, they need to bring 100,000 to the table and they transfer funds from crypto. They took some money out from underneath their bed. They're like moving funds around. If we can't source where that money came from, we can't use it. So federal anti-money laundering laws require that we source all funds that are bringing to the table for closing. So we need to make sure that those funds have been in their account for a while and we can trace that. So if people are moving money around and they can't tell you where it came from, then that could potentially kill a deal. Also, buyer switches or changes jobs. So this is common, like a nurse who went W-2 and now they went contract nurse to 1099. They now need to wait 2 years as a nurse to show consistent income as a nurse. Even though they're in the same line of work, this is where we most likely see it is nurses going from W-2 to 1099. So if you guys notice, or if you have a buyer that says they're thinking of switching jobs, even if they're going to the same job, just say, okay, did you talk to your lender? Are you staying W-2? Because as soon as you're 1099, you're self-employed and that's a 2-year history that we need. So that can kill a deal. If they open a new line of credit, go get a new car, go buy a new dog. I've had all of that happen. We'll get notification if anybody takes on new debt through the transaction. So if you guys see somebody rolling up in a new car, you need to say, hey, I see that new car. Did the lender approve that? If the buyer omits or doesn't tell us, the most common with this is child support alimony that they may not have disclosed and then we see it on their pay stub. It can also be like timeshare fees, like we see timeshare fees coming out of their bank account because timeshares don't often show on their credit report. So if they omit this information, they don't tell us, and that pushes up their debt to income ratio, then that can affect the pre-approval as well. Appliances, we always recommend that they wait to go buy and make those major purchases until after their loan has funded. So we'll say, congratulations, your loan is funded. You can pull your credit. You can do what you want to do. You're free to do that once we say your loan has funded. Until then, we say, don't use it. They can use existing credit cards. They just don't have your credit pulled. That's the key. If it doesn't require a credit pull, you're fine. So if you're using existing credit, then that's fine. But those are things that can kill a deal. Now, this is something, if you guys don't have a military background, these are terminology, acronyms that you will want to know. So BAH, so what does BAH mean? BAH is your basic allowance for housing. So that's basically what the veteran is paid for their housing or mortgage payment to offset their housing costs. And LES is like a pay stub for civilians. That's their earnings statement that gives a breakdown of their pay. PCS is permanent change of station. So if I'm getting orders from California to Virginia, I'm going to ask for your PCS orders, which is going to tell me where you're going to be stationed. And it's official, like you're officially getting PCS orders to move to a different place. TSP, so if somebody says, oh, I'm still waiting on their TSP, that's the equivalent of a 401k, a thrift savings plan. And then their duty station. So let's say that somebody's going to be working in Chesapeake, but they're going to live in Elizabeth City. Are we going to use their Elizabeth City BAH rate or Chesapeake? We're going to use their Chesapeake because that's where their duty station is. So that's why we always say, where's your duty station? Not where you're going to live, but where's your duty station? Because that's where we're going to determine their BAH. So if you guys don't know these terms, I definitely take a picture of this and save that so you get familiar while working with veterans. It's really important you use the terms that veterans use to show that if you're saying I'm a VA expert and you're like, what's a TSP? That's really like, you need to know what these terms mean. These are, and if the lender or we're saying, oh, we still need their TSP, we're still waiting on their PCS orders, we're verifying their duty station. These are terms that you guys should all know. Also, address of record. Let's say we have somebody on a ship and they're like, well, I don't have an address. I live on a ship. What we'll do is we'll ask for their address of record. So usually they'll have like a family member. They'll use like their home address, their mom's, their dad's, a family member would be their address of record. So if they're like, hey, Wendy, they're filling out their application and they live on a ship, what do I do with that? I say, use your address of record. So everyone should have an address of record. So I want to talk a little bit about our veterans and anybody. So you don't have to be a veteran, but we do offer free credit repair, which is called our Lighthouse program. So for people wanting that are motivated to purchase a house, okay, it can't just be anybody. They have to have the intention of buying a house. If their credit's not quite where we need it to be, we don't say, okay, see ya, like good luck to you, go figure it out. We offer a free dedicated rep. Her name is Haley. She does all of our credit. This is all she does day in, day out. And I say never guess on your credit. So some people say, oh, my credit's gonna go up, I'm gonna pay off my auto loan next week. Well, that helps your debt to income ratio, but it's actually hurts your credit. So it's good to have an auto loan. It's good to consistently make a payment on an installment loan. It's good to have a mortgage. When somebody takes out a mortgage, your credit score is gonna go up because that's showing consistency. It adds that mortgage to your credit. Credit card debt, it's good to pay that down. You wanna be at about 33% usage. So people will guess like, oh, I'm gonna do this and it's gonna fix. I say, don't guess. Get in our credit repair program. She'll do a simulator and say exactly what you need to do. Like contact this person for that collection, settle for less than the balance. Like it's very specific on what is needed. And it's basically an algorithm that she'll put it in and it will spit out like, this is exactly what this person needs to do to get their scores up, and this is the time frame. And we'll work with them for however long it takes. So there's no rush. Like we've had people a year later get repaired and I'm like, here you go, John, just fixed up your buddy. It's been a year. And he's like, sweet. So, you know, it's again, working with the experts. This is all they do day in, day out. There's no cost. Again, just the motivation to actually buy a house, not just because they want their credit fixed.
That wraps up the first part of our VA loan series. Thank you so much for joining us today. Don't forget to like this video, subscribe to the channel, and drop your questions in the comments below. In our next video, we'll dive deeper into the VA loan process and what you need to do to get pre-approved. See you there.